This is lecture number 2 for week 10. We are still in the chapter for segment reporting. Okay, just to refresh your memory, the first thing that you have learned in this topic is about segment reporting. How to prepare income statement for a business that has several segments. If you check the lecture notes, you will see that most of the time managers prefer to use variable format income statement. And then when a manager or when a business has several segments, and then you need to prepare an income statement for this business, you have to use the variable format income statement, and then the fixed cost of that business has to be divided into two categories: common fixed cost and traceable fixed cost. Traceable fixed cost can be allocated to different segments, but common fixed cost cannot be allocated. And you have seen in the previous lecture, if you allocate common fixed cost to different segments in the business, the segment margin of that segment will become the segment margin will not show the true performance of the segment. And also you have seen in the previous in the lecture notes, if you try to allocate common fixed cost to different segments in a business, the risk is you will make a wrong decision about the performance of each segment in the business. Okay, you better check the lecture notes if you you cannot follow the thing that I have said. And the second thing that the second half of this topic is about how to evaluate the performance of segments in a business. Let's say there is a business, and that business has two segments, segment A and segment B. So in the second half of this topic, you will learn how to evaluate the performance of segment A and also segment B. How to say that segment A is good, or how to say the segment A is not good. When you evaluate the performance of a segment of a business, actually you also evaluate the performance of the manager of that segment. Let's say you evaluate the performance of segment A in a business. If the segment makes profit, then you can say that the performance of the segment is good. At the same time, you can also say the performance of the manager of that segment is good. If let's say you evaluate the performance of segment B, and then you see that the segment B is making loss, so you can say that the performance of the segment is not good. At the same time, you can also say that the performance of manager of the segment B is not good. The performance of a segment reflects the performance of the manager of that segment. This is because the manager is the person who is responsible for that segment. Okay, so when we cover, or when I explain about the performance evaluation of a business segment, I have told you in this topic you will have to know about two methods that can be used to evaluate the performance of the segment. The first method is called return on investment. In the previous lecture, I have explained about return on investment. So, if a business uses return on investment or ROI to evaluate performance of a segment or segment manager, then the business has to set a certain percentage of return on investment. If the manager perform better than the percentage set by the business, then we can say that the manager is performing well. If the manager ROI is lower than the percentage set by the business, then the performance of the manager is not good. You can check the previous lecture if you want to refresh your memory about return on investment. Okay, this is the second method that can be used to evaluate the performance of a business segment and also the business segments manager. Okay, the name of this method is called residual income. Okay, residual incomes means net operating income above some minimum return on operating asset. Net operating income is net profit. Okay, let's see. So this is an example how to calculate the residual income. Let's say there is a division of a business named Zephyr Incorporated. A division of Zephyr Incorporated has average operating asset of $100,000 and is required to earn a return of 20% of this asset. In the current period, the division earns $30,000. Okay, something that you have to know also, if you can remember, ROI or return on investment method has several weaknesses, and residual income method is a method that can be said as better because it can eliminate the weakness of ROI. Okay, let's see. Let's calculate the residual income. Okay, the data that you can see here is $100,000 average operating asset. Required rate of return is 20%. In the current period, the division earns $30,000. So let's see how to calculate residual income. Okay, well, if you have to calculate residual income, you have to do two steps. First, you have to do the steps shown in the yellow box here. First, you have to show the operating asset and then times the required rate of return 20%. So you can get the required income 20,000. After you got the required income, you do the second step. See the green box there. Actual income of the division is 30,000, and then you minus the required income 20,000. So the residual income is 10,000. If a division has positive residual income, then it shows that the division is performing well. If a division has negative residual income, then it shows that the division is not performing well. Okay, let's see. This is another example, and this you will see here comparison between the ROI and residual income method. And at the end of the example, you will see that residual income method is better compared to ROI in terms of it encourages managers to take new investment opportunity. ROI sometimes it discourages manager to take new investment opportunity. So let's see. Okay, there is a business. The name of the business is Redmond Awnings, a division of Red Up Corporation. has a net operating income of 60,000 and the average operating asset is 300,000. The required rate of return for the company is 15%. What is the division ROI? Okay, this, like I said earlier, this question or sample question will compare ROI and residual income. ROI method and residual income method in evaluating the performance of a business segment. So the question is, what is the division's ROI? So how to calculate the ROI? You use this formula. Remember the ROI, to calculate the ROI, the formula is net operating income divided by average operating asset. So net operating income for this segment is 60,000. The average operating asset is 300,000. So the ROI is 20%. Remember, ROI equal to 20%. Now, Redmond Earnings is a division of Wrap-Up Corporation. Net operating income is 60,000. Average operating asset is 300,000. Okay, if the manager of the division is evaluated based on ROI, will she wants to make an investment of 100,000 that will generate additional net operating income of 18,000 per year? Okay, this is a question. So let's see how to answer this question. Okay. The question asks you, if the manager is evaluated based on ROI, the manager will invest or not? Okay, so the thing that you have to do is you calculate the new ROI. If the manager accept the new investment, then the new ROI is 78,000. The net operating income is 78,000. Why 78,000? Because the existing net operating income is 60,000. You have to add 6,000 with 18,000. 18,000 is the net operating income of the new investment. So the net operating income becomes 78,000 divided by average operating asset. The existing average operating asset is the 300,000. The operating asset for the new investment is 100,000. So 300,000 plus 100,000 equal to 400,000. So ROI for the division, if the manager accept or do or take the new investment, is 78,000 divided by 400,000 equal to 19.5%. So what do you think? The manager will want to make the new investment or not? The answer is no, because if the manager do the new investment, the ROI of the ROI of the division will become 19.5%. Before, if the manager does not take the new investment, the ROI is 20%. So the manager will not want to take the investment, because the new investment will make the division's ROI becomes lower. This is the problem with ROI. Like I said earlier, ROI sometimes can discourage a manager to take or to do new investment. Okay, let's see the next thing. The company's required rate of return is 15%. Would the company wants the manager of the Redmond owning division to make an investment of 100,000 that will generate the additional net operating income of 18,000 per year? Okay, remember the company has a rate of return 15%. So So with this rate of return, will the company want the manager to of the Redmond earnings to make the new investment? The answer is yes, because the new investment ROI is 18%. The new investment ROI is 18,000 net operating income divided by $100,000 asset. So the new ROI is 18%. The company wants the manager to take the new investment, but if the manager is evaluated using ROI, the manager do not want to take the investment. Okay, this problem can happen if a business uses ROI to evaluate the performance of a division and also the division's manager. Okay, and then let's see here. Now we use the question asks you to use residual income to evaluate the performance of the manager. Redmond earnings, a division of Wrap-Up Corporation, has a net operating income of 60,000 and average operating asset of 300,000. The required rate of return for the company is 15%. What is the division's residual income? Okay, so like I said earlier, if you have to calculate residual income, you have to do two steps. First, you calculate the residual income. So residual income is net operating income times the required rate of return of 15%. So 60,000 minus 45,000, the residual income is 15,000. And then the net operating income of the division and then if the manager of the Redmond earnings division is evaluated based on residual income, will she wants to make an investment of 100,000 that will generate additional net operating income of 18,000 per year? The answer is C. The net operating income is 78,000. If the manager do the new investment or take the new investment, the net operating income will become $78,000. $60,000 plus $18,000. And then the required rate of return 15% times 400,000. Why 400,000? 300,000 is the average operating asset of the division, plus if the business or the division take the new investment, the division has to invest another $100,000. So $400,000. 15% times $400,000 equal to 60,000. Residual income is equal to $18,000. So the manager will want to do the investment, because if the manager do the investment, there will be an increase of 3,000 in the residual income. See the difference? If the business uses ROI to evaluate the performance of the manager do not want to take the investment. But if the business uses residual income to evaluate the performance of the manager and the manager's division, maybe most probably the manager will do this investment. So you can see that residual income method can be said as a better method compared to ROI method in evaluating the performance of a segment of a business and also the performance of the manager of the segment of the business. See the thing written in these notes. Residual income encourages managers to make profitable investments that will be rejected by managers using ROI. Okay, so this is the end of this topic. make sure you read the lecture notes again. And this is not a difficult topic, very easy to master. The thing that can be asked related to this topic is like this. Maybe the thing that can be asked in the assignment or in the final exam or anything is like this. The question can ask you to prepare income statement for a business that has several segments. So make sure you know how to prepare income statement for a business that has several segments. Like I said earlier, the main thing is you have to divide the fixed cost into traceable fixed cost and common fixed cost. Only traceable fixed costs can be allocated to the segments of the business. Common fixed cost cannot be allocated. Okay, that is first thing. The first thing that can be asked. The second thing that can be asked during the exam or assignment or anything is you can be asked to calculate residual income for a division or a new investment. And you can be asked to calculate ROI for a division or a new investment. And then most of the time you can be asked about which one is better, which method is better in evaluating the performance of a division or segment of a business, ROI or residual income, and why it is better. Okay, thank you very much. This is the end of the lecture. Write your name and matric number in the comment section. That is your attendance for this lecture.